As I had said before, good morning. My name is Don Vivrette. This is Financial and Estate Literacy. This is It's Your Money, spring 2023. Good golly, time passes. This is week 4. We're going to talk about investment world. As we go through this, just to let you know, in the material that we have, there is a workbook that I had done a while back just to sort of tie the various pieces together that we talk about in here. It's for your use. It's on the website. It shows here on the side at the bottom. You can download it, use it if you want to. Don't use it, whatever you'd like to do. It was just as a reference for you. It's not. We don't collect them. We don't grade them. It's a sort of a thought process to get ready to talk to a financial advisor or estate planning on the other one. So there's one for money and there's one also for estate. That's available to you as you would wish to use it. Where we stand is we're at week 4. We're doing investment world this week. A little bit out of order just because of some scheduling timing. That's fine. We cover all the subjects. And so that's what we're going to be doing today. And so what I will do is, as I have done before, I will disappear in a moment. I'm going to stop sharing. So it's Pete 9. We have one question here. I'm sorry.
That's me.
That's you. Oh, thanks a lot, Pete. What'd you tell me to turn on the microphone?
All right.
Anyway, so Pete, and the website's there. Do you want to use it?
Yes, for just a little bit.
Then let me go back here and let me share that screen. There you go.
Yeah, this is our financial and estate literacy website page. IYME is the shortest one link that you can use. You can click on workshops, or excuse me, click on It's Your Money first, and then you'll see our schedule. And
and these are the videos are already here from the weeks before. So that is here. We're slightly out of order. So if you go to investment world,
and if you scroll all the way down
before we go there, so if you want to have a copy of the handout material or the material used today by Michael and Paul, it is here. You can download it. Their Ask First forms are here, a blank one, which Pete wants you to have. And here's the workbook if you chose to use it. And where Pete wants to go is down here to articles.
Yeah, here are the articles that were kind of pertinent to today's session. Of FINRA, we're going to hear more about that. It's really, really important. Just some of the schemes that are involved in the financial world. We talk about that. Annuities, there's some further articles on annuities, reverse mortgages, the steak dinners, this is the investment world today. And although our 2 presenters today are not in that world, they're going to talk about that world because for most of us, for the general public, they're in that world. So let's go back to Michael and Paul. Come online and let's give you a quick introduction.
And before you do that, I'm going to disappear. I'm going to monitor the Q&A and answer questions as I can along the way. And otherwise, y'all have a good time.
All right. I am not going to go line by line through your Ask First forms for you, either Michael or Paul. They're available online and for the attendees to review. What I am going to do, though, is ask Michael, talk a little bit about your fees, because that's one of the most important things for a person to know.
Yeah, thanks, Pete. Thanks, everyone, for joining. So we are fee only, as Pete mentioned at the beginning of the call. The only way we get paid is based on either a financial plan hourly rate, if we do a financial plan only, or based on assets under management, a percentage fee on that. No commissions, no product sales, no referral fees, which we will cover today in the investment world, and things to be aware of.
And what is your hourly rate?
It's typically between $250 to $350.
And then what's your assets under management rate?
Yeah, it on average 1%. It's a tiered rate, going down to 0.5%.
Okay.
Up to
And
1.
is there any minimums?
We know our motto is to help everyone. We have a retirement side of the business where we work with plan participants. We work with kids of clients. So our bare minimum's $5,000, but we really have clients from $5,000 up to $35 million. So
I, you've been in the firm as 16 plus years.
yep.
And do you offer a free look-see, or how
We
can
do.
somebody get to know you?
Yeah, we do. We'll do a free meeting where we get to know our client, and then also a portfolio review as well.
Okay. Gosh, excuse me, Paul.
Yep.
How long have been in the financial services industry?
Since 2005, so 17 years.
17 years. And what do you bring to the firm that you've to let's I always forget the name of your firm.
Because it's a,
Yeah,
it's a
it's-
mouthful.
Benefit Financial Services Group, but we go by BFSG because it is. a
Yeah,
mouthful.
explain a little bit why it's important. We're going to talk about registration in FINRA, but talk a
Yeah.
little bit about why it's important to know the firm.
It's important to know the type of firm that you're working with. I myself started my career like Wells Fargo, JP Morgan, and we'll talk more about that, but that is what's called a broker dealer. And they're not necessarily a fiduciary, which means they're not necessarily what's doing in your best interest. What they're going to sell you just has to be quote unquote suitable. So it may make them the most money, but it may not be truly what's in the client's best interest. So I started on the dark side of my career there in about 2013, saw the light, moved to what's called an RIA, a registered investment advisor, where it's completely independent, not tied to any product selling or a broker dealer, which requires commission sales, and truly able to be a fiduciary and do what's in the client's best interest at all times.
Yeah. And both of you guys are certified financial planners.
Correct.
and that entails lots of ethics, and that is a credential that is legitimate, not easy to get, or to continue receiving it. And so congratulations to both of you. Let's go. Paul, your Ask First is on the website as well.
Yep.
Up there it is. And so you have the same fees as the firm, as I understand it. So let's get into, by the way, both of you guys are wonderful. You have great backgrounds, but what I'd like to do is get right into the program and get started.
Sure.
All right. Who's going to lead off?
I will. And we're going to get right down to, as kind of Paul mentioned, the difference between a registered investment advisor and a registered rep or a broker. And we're actually going to check out a website as well that we'll look at and how to tell if someone's a fee only or a broker. So Paul already kind of alluded to a registered investment advisor. We legally function under what's called a fiduciary standard, which is we always have to put our client's best interest first at all times. And so that's really important, and a big difference of a registered rep or a broker, where they legally function under a best interest standard, which is only effective just a few years ago, as of 2020. Paul mentioned this, a suitability standard prior to that. But it's still kind of muddied the waters.
They put a different definition in there on best interest. It's just mind-boggling.
Yeah, they have a lot of campaigning, and they really muddy the waters with what the difference between a fee-only registered investment advisor and a registered rep. But it's more transactional. It's still a transactional relationship on the broker side. They have to provide what's in your best interest at the time of the transaction, and they don't have to look at the whole picture. And so, whereas we are looking at the whole picture, acting with prudence and what's in your best interest at all times.
Yeah, probably 85, 90% of the individuals in the public sector of the financial services industry are registered representative. They are brokers.
Yeah.
So there are thousands of brokers here in Orange County. I would say there's probably maybe 100 to 150 fee-only registered investment advisors here in Orange County. To give you the difference.
Yeah, actually, out of the SEC registered investment advisors, only 20% are fee only.
Yeah.
So even with a registered investment advisor acting as a fiduciary and held to that standard, you still want to look for someone who's fee only, who doesn't sell products and stuff as well.
Yeah, and that's where the compensation comes in. How do you get compensated? That's the question that you need to ask, because a fee-only advisor is not licensed to accept a commission, correct?
Correct. Yeah, I mean, we don't have a license. We've had a new hire last year. He had his insurance license, which is a great background to be able to, talk about insurance, but we don't, his license is not hung up somewhere at a shop where it expired.
Yeah.
In a sense. Yeah.
Okay, let's go to the next slide.
So some really important things we've touched on already on how to find a financial advisor and important considerations. Again, fiduciary, fee only. Pete talked about the education. Paul and myself are CFPs, or certified financial planners. Paul's also a CPWA, certified private wealth advisor. We've got a few CPAs and CFAs on staff as well. It's just where's their specialties in financial planning and taxes and investments, but those are the most widely recognized designations.
And legitimate,
And legitimate, yeah. Only about 30% of financial advisors in the US are CFP professionals.
What's the qualifications to be a broker, Paul?
Get your license.
Yeah,
that's it.
18,
That's
right?
it. Yep. Yeah, and there are, I'm not joking, probably 200 to 400 other designations that you can get. Most of those come from the same colleges that are for profit, like University of Phoenix type stuff.
Yeah, yeah.
So,
yeah.
People tend to believe people with designations behind their name.
Yeah, those 3 letters look important. Makes me feel important.
Yes.
The other things to look for is a third-party custodian, for example, Schwab, Fidelity, or other third-party custodians. You don't want to be a victim of the next Bernie Madoff. So make sure someone is holding your assets.
Who do you guys custody your assets with, and why is that important for a client to know?
Yeah, we use Schwab and Fidelity. Those are the 2 custodians we use, and it's really preference from the client at that point. But they're the 2 largest ones out there. The safety of the assets are really important. Also best execution to make sure that we are getting the best pricing for our clients, and they both hit those marks. So it's really important for the safety and protection of clients' assets.
What rights do you have on that account as the financial advisor?
Yeah, the client gives us authorization to trade and pull fees, our management fees from the accounts, and that's it. Any type of money movement needs client signatures. Any type of beneficiary updates or address changes need client signatures. So we can't change the client's address, send money out to my address here at my house. And so it's, again, all about the protection of clients' assets.
And if I want to fire both you and Paul, I said, I've had it. I don't like you guys any longer. Do I call you, or do I call Schwab or Fidelity, or do I have to do both?
Either way, you can start with the custodian and then they notify us, or you notify us and then we notify the custodian, and the accounts get removed from our management and they become what's called house or retail accounts at Schwab or Fidelity.
Yeah.
So
yeah.
Easy. It's really easy, and not hoping you don't fire us, Pete, though.
Well, the thing of it is that this goes for investments and with individuals. Before you hire them, you want to know how to exit.
Yeah.
And it's very easy to exit. Whereas if you're with a broker, you're more than likely will be in commissioned mutual funds. And once you're in a mutual fund on a commission, you can't get your money back. Whereas if you're with a Michael or a Paul and you say, I'm leaving you, your fee ends right there and then.
Yep. And we're going to touch on the different kind of mutual funds with commissions. Also, annuities are a big thing where we see those a lot of times.
Yeah. And
then it's a pain to get that advisor off of that annuity and treat it as a house account. So there's a lot of stickiness and loopholes, or not loopholes, but you got to jump through a lot of those things. So it's a pain.
And besides fees and all that, it's a marriage, money, so look at some of the other needs. I like the way you put that in the outline. Similar clients, how often do you meet? How do you make the investment decisions? What services do you offer? And are there additional costs? These things, how much time do you spend with your clients on the front end before they say, okay, let's have a marriage?
Yeah, Paul, you want to?
It just depends. Yeah, it depends on each client. Is different. Some clients, it could be 30 minutes to an hour. Other clients, we spent 4 to 6 hours before they're comfortable moving forward. But the reality is this is literally your life savings. We don't take that lightly. So you need to be comfortable with us before you proceed. We actually won't sign you or have you join us until we feel that you're comfortable and ready to move forward.
Yeah, this program is not to get you into a fee-only advisor's office. But we do think that at some point in time in your life, you may want the services of a fee-only advisor. And that's why we're kind of going through. And this particular session is about avoiding some of the pitfalls of the investment world. What is an ADV form?
Yeah, so that's a disclosure brochure that we have to file with the Securities and Exchange Commission. They are the ones that regulate us, audit us, and so on. And it's really the most dry reading you've probably ever read, but it describes who we are, how we operate, any conflicts of interest, how we mitigate those or eliminate those conflicts of interest, and so on. So it's really important, and we're required to provide that to clients up front at the beginning of the relationship and offer it annually and any changes in that. So it's really important.
Right. And yes, this is
Let's talk about the SEC. That is the government agency that oversees the financial industry. So their job is to help make sure that securities transactions like purchase of stocks, the activities of financial professionals like Mike and myself or the brokers, mutual fund trading, to prevent fraud, manipulation, and deception. So ultimately, they're the ones that oversee the entire industry. To help with that process, there is what's called FINRA, the Financial Industry Regulatory Authority. And this is what's called a self-regulatory organization. So this is made up of members of financial professionals that operate on the New York Stock Exchange. It is a non-government organization, but they do try and regulate member firms and exchange markets as another layer of kind of enforcement and trying to reduce the risk of fraud or deception. But ultimately, it's the SEC is the one that we pay attention to and report to.
And anyone who is in the financial services industry has to be registered with FINRA. Is that correct?
Correct.
Yeah.
No, not with FINRA, with the SEC.
Well, yeah, but FINRA is the mechanism for registering both for the SEC and for the broker side.
Perfect. I'm just a salesman.
Yeah. Yeah. Well, that's what FINRA is for.
Yeah,
no,
I mean, yeah, for sure.
Yeah, it's to regulate sales. I mean, you can sell, but sell ethically.
Of course.
Yep, for sure.
Yeah, and what does it take to sell? It takes investment licenses.
Yeah.
And so if you're working with a broker, you're going to see a lot of Series 6, Series 7, Series 63, Series 65, maybe Series 66. Series 66 is just a 63 and 65 combined. Okay.
And 65 is kind of the one you have, which is more of a registration.
Correct. Yeah.
And
Holder can give investment advice.
and I can tell you they're pretty darn easy to get. I mean, it's been a while since I took my Series 65, but it took me maybe 2 weeks of studying and I passed it.
I compare
The
it
Series
to
7, yeah. Fresh
I
out of
compa-
college for me, Series 7 was 4 weeks and 2 weeks for the 66, which is the 63 and 65 combined.
I relate it to a real estate license. It's a little more difficult than a real estate license, but not that much more difficult. The hurdle to get into the investment world is very, very low. You know, but if you see a Series 7, that person is a broker.
They're selling commission products.
Yes, or has the ability to sell commission products.
Yes. Yeah, I mean, the reality is when I started in the industry, like I said before, I started at Wells Fargo and JP Morgan, and I was Series 7, 63, and 65 licensed. Since then, I've jumped over to the RIA side, from the dark side to the light. And that's not to say that people that are at broker dealers aren't doing ethical sales. I know people that still work at broker dealers that I would trust with my money, but to reduce conflicts and reduce the chance of being sold the wrong product, it's much easier to watch out for that. I mean, the reality is since I've started in the 17 years I've been here, I can show you 100 different people like myself that started at broker dealers and left and are now an RIA or an independent advisor. But I'm yet to see one person that's an independent advisor go back to or go to a broker dealer.
Very well said. And I like the fact that you indicated that not all brokers are unethical, because that's not what we're trying to say.
No, not
It's
at
just
all.
the
Not at all.
conflict is so huge in the broker industry.
And
And there's a lot of pressure. I mean, for me, I was at JP Morgan. I was one of the top new salespeople, and I got called out by my boss's boss on a national sales calls for not selling enough annuities.
Yeah.
Annuities aren't bad, but they're not right for everybody.
Yeah.
But they're a highly profitable thing for the broker dealer. So I was getting called out for not selling enough because their quotas that they wanted us to meet. And so for me, that was the last straw. Like,
think of let's just randomly name a bunch of products that are on commission: mutual funds, annuities,
life insurance,
mortgages, gold, stock, bonds,
options,
real
what
estate.
else?
Real estate.
Partnerships, oil and gas,
private equity, hedge funds,
commodities, options. I mean, the investment world is littered with products. It's almost like going to a Mercedes car lot and all these cars and all these products are there. And the car salesman at the Mercedes lot says, "I'm your advisor." Really?
Now we
It
talked
doesn't make
about,
sense.
yeah, we talked about FINRA and the different licenses that they offer. Because they have the license, you can look up any advisor, whether they're on an RIA or a broker dealer. And the website it's called Broker Check by FINRA. To get there, you literally just in Google type in Broker Check. It'll be the first link. And then you can just type in the name of an individual that you're talking with. You can see information about them. Have they been accused of unscrupulous sales activities? Have they filed for bankruptcy personally? A lot of that sort of information you can find on not only them, but on the firm as well. So I would strongly recommend, if you are looking at any financial advisor, this is an excellent resource to kind of check under the hood, so to speak, and really see what's going on, what other people's experiences are. Ideally, you're looking for someone that has zero disclosures, meaning they've never been accused or don't have, they have a clean record.
Now, if you go to Oppenheimer, if you go to Wells Fargo, if you go to Merrill Lynch, there is 65 to over hundreds of disclosures. Oppenheimer, 1 out of 5 of their sales agents has a disclosure. And the disclosure are those, I mean, I think it's pretty difficult to get a disclosure, first of all.
Yeah, if you have a disclosure, you probably did something wrong. So I can only think of one thing where maybe it wasn't the advisor's fault.
Yeah.
In my 17 years, I've only heard of one situation where it maybe wasn't the advisor's fault.
Yeah. Anyway, let's go to the next slide. Broker check, one of the most important things to know from this session.
Yeah. And again, just Google broker check, 2 words. It'll be the first link on.
It's one of the first, anybody who tells me, I get a lot of people wanting to be presenters of the program. And the first thing I do when they mention they're in the financial services industry is look them up on broker check. The entire financial services industry operates on full disclosure. That's why you have a prospectus. That's why you have a broker check. That's why you have ADV. If you are a reasonably intelligent individual, if given all the information that is out there, you'll make the correct decision. That's the philosophy. I disagree with that philosophy because everything is written in legalese, 8-point type, very difficult to understand. So, but full disclosure is the key to for operating under the financial services industry in the United States.
Yep. So let's talk a minute about life insurance and the types. Really, life insurance can be broken down to 2 types. Either what is term, which typically lasts from 10 to 30 years, or there's what's called permanent life insurance. There's different flavors of that, like whole life, universal, variable, but permanent life, that is designed to cover the rest of a person's life. The reality is for most individuals, term is all you need. Because when you're young, you know, or younger, you have kids, you have a mortgage, you're still increasing your earnings and still increasing your net worth. So there's a need for life insurance at that time. But fast forward 20 years later, that need's probably less. Kids have probably gone to college and out of the house. That mortgage hopefully is mostly paid down. Hopefully you've accrued more assets. So your need for life insurance tends to decrease over time. So for most individuals, a 10 or 20-year term is more than sufficient to meet their needs. It's very cost effective. You know, if you're young, those policies could be as little as $30 to $100 a month, depending on your health. Permanent insurance, those are policies that last your lifetime. Those tend to be used for more complex cases. If there is a child that has special needs, that's going to need additional help to make sure that they're financially covered the rest of their life. If there are some concerns about estate planning issues, things like that. If you have a lot of real estate, you might want a permanent policy to create some liquidity at your death, things like that. But those policies build a cash value over time. The idea of that cash value is not to be an investment. I've seen Northwestern and too many other places that prey on new doctors, prey on individuals, and sell them these permanent policies as an investment. It's a terrible investment. Your earnings are going to be capped, and your fees are going to be in the neighborhood of 3 to 5% per year. So don't look at these permanent policies as an investment. Look at them as meeting a specific need at your death. That cash value, just so you guys understand, as we know, the older you get, the more expensive insurance becomes, right? Well, instead of your premiums increasing over time on those permanent policies, the idea is you pay more in your early years. So you overfund the policy, creating that cash value. That cash value is invested, and that cash value is supposed to be used to offset those future premium increases. It's not supposed to be an investment.
I think of a probability curve, like 95% of the time, term's probably the right thing. It's permanent is on kind of on those extremes from a tax or like Paul mentioned, special needs, like where they make sense. Most of the time we see term as the option that is usually needed, but unfortunately we see the opposite where we see more permanent policies being sold because that's where the commissions are.
Yeah, the commission averages between 6 months to a year and a half of your first year premiums. So it's not cheap. Another thing I'm seeing lately is they're selling permanent life insurance with long-term care riders. When somebody comes to you,
Wait, let me stop you for just a minute while we're talking about this way. Question just came in. It's an interesting one. I want to present it to. I'm turning 71 and have a term policy for 20 years. They just raised my premium 50%. Is there a way to protect against these increases?
Unfortunately, no. On a term policy, it's set for a specific time. In your case, 20 years. So that price is locked in or guaranteed for 20 years. The problem with that is after then, the premiums come based on your age. And so that's why you're seeing that 50% increase. So the only way to protect against that is buying a longer term policy or buying a new term policy. Because after that 20 years is up, it becomes what's called an ART or annual renewable term, where you can keep the policy, but those premiums are going to jump significantly and only increase each year.
And I would then ask the question, I mean, what's the need? Is there a need for insurance still at that age?
Right.
I mean,
Yeah.
mortgage paid off or not? I mean, what are the needs? Or is it there's a need to continue it or not?
And that's the kind of thing, if you were talking to someone as a financial advisor, you would review all of that with them.
Yeah.
Correct.
and then say they need insurance, Michael, Paul, what do you do?
At that age you're talking about for this specific question, or?
No,
Yes, at that age. I'm going to ask at that age.
Yeah, so we'll review it, and if there's a need, again, we're fee only. So I sold life insurance for 14 years, 13 or 14 years. I don't sell it anymore, but we know individuals that we trust that we will refer you to. We get no compensation. So we're putting our name on the line to help our clients out to get that product.
And you don't get a kickback.
No.
Nothing.
And I think we look for a broker where they can go shop for the best rate, whereas someone at like a Wells Fargo, if they're selling insurance, they're only going to, one, they're getting a kickback or commission on it. Two, they're only going right to the.
It's a perfect example of the potential conflicts that are in the financial services industry. Let's go to the next slide.
Yeah, so annuities are actually a type of insurance. And there's really what we're going to focus on is some deferred annuities, really the types, fixed annuity, variable annuity, and an indexed annuity, which we are seeing more and more of. Fixed annuities, it's as it sounds, it's fixed. You buy a annuity, you get a fixed rate. Older contracts were a little more attractive. Newer contracts, until the recent increase in interest rates, you didn't see many fixed annuities just because they weren't paying anything. So with interest rates popping back up, it's a little more attractive, but you have to keep in mind inflation as well. And where's that going to land? Variable annuities, it's really, again, as it sounds, variable. You invest your money in stocks and bonds, and typically in mutual funds. You carry the investment risk, so there is the potential to make or lose money. And unfortunately, most of the underlying investments have higher expense ratios, and the commissions on variable annuities are much higher. So that's why you see those more often, or used to. What, Pete, the average commission, I think, is probably around between 3 to 5%, but I've seen higher as well on those.
I've seen 8 to 11.
Yeah. So yeah, it's can be very high. Indexed annuities, which we'll dive a little more deeper into in a few slides, really those are linked to some type of index. Most commonly, think of like the S&P 500, the 500 largest US stocks. You make money if the index goes up, and then they cap the downside. So if the index is negative, like last year, your return's 0 instead of losing money, which sounds amazing. You get upside and no downside, and that's how they're sold. But there's a lot of
Trickery.
Yeah,
trickery,
this
and
is
bells
the
and whistles they
hottest
put on.
product out there, the hottest. It's like the new Tesla is the
Yeah.
indexed annuity.
And
Man,
the other,
we're-
yeah,
you're going to talk a little bit more about it, but every
Yeah.
single free dinner, this is what they're selling.
yeah. And again, you get upside, you get no downside, and there's no, they say no fees, which is I can't believe they can say that,
Yeah.
because the
And,
fees
and I'm going to add a
the
fourth
product.
kind of annuity, and it's a charitable gift annuity, and it's a darn good thing, depending on your age, and that's a different world than the commercial side. So just
Yeah.
because I teach the charitable side, I'm going to raise that one as an issue.
Yeah,
Thank you.
that is a wonderful product in the investment world from
And nobody makes any commissions, and that's why you hardly hear about them. So from a financial advisor, and a commercial annuity is anywhere from 15 to 30 pages. A charitable gift annuity is like 2 pages. So, and nobody makes money. Let's go to the next slide.
All right, let's understand the fees when it comes to an annuity. Right.
Yeah, so it kind of alluded to on that variable contract. The fees are high on a variable and also on an index annuity, on really most annuities. But the other thing is liquidity. They have surrender charges. So if you try to get out of them in a specific time frame, and we've seen up to 15-year surrender charges, more common is 7 to 10 years. So for in this example, this is a real example of a client that came to us with an annuity. And you see the surrender penalty in the first year. To get out of it, you go, oops, I made a mistake. I want my money out, or I had some big life event happen. You're going to pay an 8% surrender fee. So if you put in 100,000, you need that 100,000 back out. You just paid $8,000 to get back
Where does that 8,000 go?
to the insurance agent and to the company.
Exactly. Yeah,
Yeah.
that's why that you have that surrender fee, because you're this guy who, or the woman who sold you this annuity, that's exactly whereabouts what they made when you signed that contract. Is there any amount of time where somebody can get out of that contract?
I mean, as you see in this example, the surrender period gets less and less, and then typically after the period of time. So in this
I'm
example,
talking about the 30 days right to rescind.
oh, thank you. Yes, you can in 30 days. If and that's a pretty nice window, because they realize the pressure sales on these, and they give you a window to get back out of it. Once you're in it past that 30 days,
Yeah.
no. Most annuities do allow you to withdraw 10% of the contract per year without penalty. So that is something to be aware of. But unfortunately, especially, I mean, with older people who need liquidity, they get put into these products, and then their money's stuck in there to a certain extent.
Yeah, because you don't want to take a surrender hit of $8,000 on 100,000. That's a huge hit to overcome. Let's go to the next slide.
All right, so when we look at a variable annuity, there's a lot of different fees that you need to be aware of. All these are pretty well hidden within it. But the most common one is called the mortality and expense ratio. It's known as MNE. This is the actual cost to run the annuity. This is the cost that the company has to incur to create the annuity. On top of that, they will have typically an administration charge, which is typically around 0.25%. This is for the mailing of the statements and the processing of the statements and all that sort of stuff. And then with a variable annuity, remember, the money is invested in an underlying mutual funds. Those mutual funds have their own expense ratio known as a fund expense ratio, and that's typically around 1%. And then oftentimes these annuities are sold with additional guarantees. Those are called living benefit riders. These guarantees say no matter what, your income is going to go up 7% per year for 10 years or something like similar to that. And you have to pay 1% fee to get that. So most annuities on average are around 3 to 4% all in for an annual fee. So if you're earning 6% in the market, but you're paying 3.5 to 4% per year, your money's not really growing that fast.
Yeah, and one of the things with the living benefit rider, I mean, those are you often see a lot of riders attached to these. And that's again where the fees really get bumped up on them. And
Yeah.
I mentioned the underlying fund expense ratios. I mean, we can go by mutual funds or exchange traded funds, and our average fees from 0.05 to 0.25. The underlying investment options in a variable annuity often are between 0.75 to 1%.
The reason why we go through this is that the expense side of financial services product reduces your return and your net worth over time. And that's kind of why you need to understand, you want to keep whatever you invest in, you want to keep your cost and expenses as low as possible, because that's what you can control. You can't control the market.
Yeah, you want to
Let's
keep
go
your
to the next-
taxes
Huh?
and your expenses, keep your taxes and expenses as low as possible,
Yes,
because what you see as the investor is the return minus those two things.
yes.
Okay, so this is looking at that index annuity. This is the flavor of the month in the insurance world at the moment. The great thing is you're attached to the S&P 500 index. S&P 500 index has been doing 10% per year for the last 100 years. You're going to do great. And oh, by the way, if it goes down like it did last year, it's okay. You lose no money. You're just protected. What they don't tell you is how those rates are calculated for the return, and they don't talk about the caps. So on the upside, you are capped on these indexed annuities. That cap typically is around 4 to 5%. So in a year where the S&P goes up 15%, you're going to make at max typically 4 to 5%. That difference, that 9 to 10% difference, the insurance company keeps that. That is how they pay for these products. It's not with those fees like we saw on the last slide with the variable annuity. It's keeping you capped and then keeping the excess. Now here, this is an example from a client in 2020. The S&P was up that year around 13, 15%. Great year for the S&P. The client's return on this index, even though they were linked to the S&P 500, was 0%. Index up 15, they got 0. Why did they get 0? Because of their sneaky crediting method. What they say is in no month, if the S&P goes up more than 1% per month, you're capped at 1%. So you can only make 1% on the upside per month. But on the downside, you're uncapped. So if the markets go down 10%, like they did in months 7 and 8 of this illustration, they got a negative 20% return in those 2 months because the markets were down 10% each month. So even when the market was up 10% a few months later, they're capped at 1%. So the sum of all their returns for the year was negative 16%, even though S&P was up 15%. You can have a degree in astrophysics or math, doctorate in mathematics, and understanding this math is still extremely complex.
There's an
These
article.
are the games that they play.
Yeah.
Most agents that sell these don't even understand this.
Yeah, there's an article in the article section from the New York Times talking about that you need a PhD in math, and then you'll still have problems trying to understand how the return is calculated in these annuities.
And one other thing I just want to point out, I mean, the insurance company, they know the odds of the market over historical long periods of time. So the caps we typically see on these are 7 to 10%. You get the upside up to 7 to 10%, anything above.
No, the caps are 4 to 6.
4 to 6. Okay, thanks, Paul. On average, over almost 200 years, around 40% of the S&P 500's annual returns fall within a negative 10 to 10% range. About 47% of the time, annual returns have been above 10%. They know this information that almost 50% of the time they're above 10%. They're capping you at 4 to 6%. They're getting all the upside roughly 50% of the time. So they know the long-term returns, and that's that's how they make the money off of this product. The other thing that we often see is this is price only. They don't typically include dividends in the way they figure out the return. And since 1926, dividends have contributed about 32% of total returns of the S&P 500. So there's little games they play with these cap rates, not including dividends in the returns, and so on, that why we think they don't make great investments.
Don, you have a question?
Good point. Yes. So the question is, what's your view on the difference between price/fee and net cost/net value?
Could you explain that a little further?
No, I can read it again. That's the question that's asked. My guess is the question, I think the issue is, and you mentioned it a little bit before, the issue that you have is, what are your expenses and what's your return? So what's the cost that you have and what are your taxes, you had said. I'm assuming what the question is relative difference between them.
I mean, you always, what matters to investors is the net return, net of all expenses. You want to know how you're doing on a net basis. And so not just on a price only. So it's really important to know that working with an advisor, I mean, you should know, how's my portfolio performing over the long run on a net return, net of all fees.
Yeah. And by the way, most annuities, most brokers don't give you that number.
Nope.
And they can't. And so illustrating it is predicting it ahead of time is extremely difficult.
Yeah.
So we have clients that have bought annuities, not from us. We've referred them out to other individuals, and we've helped clients get annuities along the years. But in the last 10 years, I can count on one hand or two hands how many annuities our clients have bought, because it's a product that you back into. It's not a product that you lead with.
By the way, this last year, index annuities are booming. Mm-hmm. And the reason for that, I believe, is that the market went down in 2022.
Yep.
And therefore, people are afraid to go into the market when they hear that the bottom is capped, that I cannot lose money, I only can get the gains, really appeals to their security.
Yeah, and I want to be clear too. I mean, we're not saying all of the annuities are bad. They make sense for some people some of the time, but
very
unfortunately, yeah,
rarely,
rarely. And but that's the thing is, unfortunately, they don't get sold that way. Like everyone needs one, and so there has been times on the client specific circumstances where we've referred someone out to get an annuity, but that's a rare case.
It's a
annuities are typically sold, they're not bought.
Yeah, it's a billion dollar industry. It's be careful. Let's go to the next slide.
All right, shifting gears a little bit. Why are we not going? There we go. Let's talk about mutual funds and what they are. So a mutual fund is a collection of people's money to invest. So how they work here is the money is pooled together. So let's say the S&P 500, you want to get exposure to the 500 largest stocks or largest companies in the US, okay? Your money is going to be pooled with other investors with similar goals. Then there's going to be a fund manager for that mutual fund that's going to go out and choose the underlying stocks. So when you get a mutual fund, you're buying a basket of stocks. And so the fund manager is going to go out and choose those stocks for you and manage those stocks. And then the investors are going to generate returns. And those are going to go to the investors minus that fee, typically on average around 1% per year. That for the fund manager, that's their cost of doing business. And then the returns are going to go to those investors.
Approximately how many mutual funds are there in the industry?
Hmm.
20,
15.
25,000?
I was gonna say, yeah, at least.
Yeah.
Yeah,
Um,
yeah. So just think of having to go to a car lot and having 25,000 different cars to choose from. How can somebody figure this out?
It's extremely difficult. That's why, when we are making selections for our clients, we have a computer screening process to weed out 90%, 95% of those funds to leave us with, based on what we're looking for on the screener, a smaller list that is manageable, where then we will step in and do our due diligence from there.
How much time and money do you spend on screening mutual funds? Just to kind of, people, I don't think understand how much time it really takes.
it takes,
At our firm, we
yeah.
have about 6 or 7 individuals full time that this is their job,
Yeah.
is to screen and manage these investments.
Yeah, it's
And we
a lot of work.
We have a Bloomberg terminal. We have a Morningstar Direct.
What does a Bloomberg terminal cost?
Roughly 30 to 40 grand a year, a license. Morningstar, we probably spend about 250,000 a year on research and tools and so on. So it's
that's the overhead. So, sometimes people think that a 1% fee to a financial advisor is expensive. It really is inexpensive.
Yeah, I mean, really, it's our 1% fee. I think most of it. I mean, well, we think we do a good job selecting investments over a long period of time. We're mostly focused on is asset allocation, proper mix and risk for our clients' goals and needs, and then the financial planning piece of it, and saving, as Paul mentioned, keeping fees as low as possible and taxes as low as possible. So a lot goes on the tax planning side. So that's where we think our kind of alpha or benefit is on that side.
Let's go to the next slide.
All right, so mutual funds, there are those with what are called a load, which is a fee. These are the commission products sold by brokers or life insurance agent. And they come in 3 flavors. What's called a Class A share, a Class B share, and a Class C share. Class B share is a share that starts out like an A, turns into a C. These are not even allowed to be sold anymore by the vast majority of broker dealers. So realistically, we're looking at either what's called a Class A, and these are designed for a long-term investment. So with these, you're typically going to pay an upfront expense of up to 5.75%. So if you invest $100,000 into a Class A share, there's a commission of $5,750. So your net investment when you start is $94,250. You don't start with $100,000. You start with that $100,000 minus the commission, and it grows from there. And then on top of it, it's going to have an annual expense ratio that's going to be a lot lower, typically around 0.25 to maybe 0.4. And so you're paying less fees on an annual basis, but you're paying a larger amount up front. These were designed for people that are trying to stay in investment for 5, 10 years or more. The Class C share, there's no initial upfront. So if you invest 100,000, all 100,000 is invested day one, but their annual expense is much higher, typically in the range of about 2%. So if you start with the 100,000, that's fine, but now you're paying an annual fee of about $2,000 versus like $300 or $500 per year. So these were designed to be more short-term in duration. The Class A were designed to be more long-term in duration. The problem is I'm seeing a lot of brokers these days doing Class C and maintaining them long-term. So if a client may have this Class C for 10 years, where they end up paying 2% per year over 10 years or 20% versus a much smaller fee that they would have paid if they did the Class A. Now, these we want to try and avoid. The ones we want are called no load funds. The most common example of this I can think of is Vanguard. these are never done with a broker or with a middleman. These are done directly with the mutual fund company. And with these no load funds, you go directly to the mutual fund company. There is no commission. You just have that annual fee that has to be paid. And these are going to be much cheaper for you in the long run.
And at Schwab and Fidelity, for example, they're kind of open architecture. You can go out and buy, of those 25,000 mutual funds, you can go out and buy any one, and they're all no loads, typically through there. I mean, you can buy A shares and so on, but with no load, but there's higher expenses. So there's I mean, we're showing A, B, and C. Those are the ones to look out for with commissions or loads. But there's retirement share classes, our share classes for 401k plans. There's institutional share classes, which we work with, which have lower expense ratios. There's retail, our share, another type of share class that are for just going direct to Vanguard or Schwab, where you pay a little higher expense ratio just because you don't have the buying power.
Yeah. So if you own a mutual fund, which most of us do, find out, if you don't know, what are the fees and expenses related to that fund.
Yep.
It's very important to know, because
Yeah.
the more fees and expenses you pay, the less you're getting in return.
Yeah, and that can be found in the prospectus of each mutual fund.
Or go online and Google.
Yep, you can do that. Go to Yahoo Finance and just pull it up, and it's right there.
Yeah, the prospectus is very difficult to read. So, and as Michael said, there's many other classes, but your statement will tell you what class it is that you own. Okay, so
look at the back, XYZA, XYZB. It's going to say whatever that mutual fund is with the letter at the end of it.
So, and there are other fees associated with mutual funds, but let's go to the next slide.
Yep. So the other flavor of the moment, I guess until recent volatility last year, is cryptocurrencies. Specifically, we're going to touch on Bitcoin, just the largest financial instrument out there. And just we're more just not to say, is it a good investment, bad? Maybe the technology behind it could be great, but is it a currency? Is it a store of value? We don't think so. I mean, just look at the price volatility on the left-hand side of this chart. You have to be aware that there is huge volatility, ups and downs, with this type of investment or speculation. It's way too volatile to be considered a store of value. We think the products aren't quoted in Bitcoin amounts. Like, for example, oil is quoted in dollars and sold in dollars. You don't see product prices as quoted, so we don't think it's convertible in that sense. A medium of exchange, yes, there's some platforms accepting it for payment. So you can argue there's not many, but it's just, we want to more just make people aware that it is a highly volatile investment. I think the SEC chairman said it's the cryptocurrencies are the Wild West of investing. We're at that stage of the investment universe for them. So just be careful going into it.
How about gold, metal, silver? I'm going to expand it a little bit to commodities. Do you use these kinds of products in your client's portfolio?
Not really, because of the volatility as well. And you see that, I mean, well, they look much smaller than Bitcoin on that chart. Gold and commodities are still very volatile asset classes. They are only worth, really, gold specifically is only worth what will trade for it. So
yeah, from time to time we can use gold or commodities because of their volatility and their lower rates of return historically. The saying in the industry goes, I've never met anybody that got rich being a gold or commodity investor. I knew people that got rich being a gold or commodity trader.
Yeah.
So holding it for short periods of time can be an effective investment strategy, but you really should work with a professional if that's something you're looking at or considering.
What does IG stand for?
Investment grade bonds,
Investment grade and core
yeah.
CPI, what does that mean?
inflation.
Okay. And finally, cash is showing a little bit of a return lately.
Yeah, and so cash is no longer trash.
Yeah,
So
exactly.
cash, I mean, money market funds, CDs, treasury bills, all cash and cash type equivalents. Today you can get paid 4 to 5% roughly on those various cash-like investments. The problem, and while that's great for retirees, it's great for your emergency funds that you're getting paid to keep those funds. It's still not a long-term investment vehicle because just cash, as we've seen over long periods of time, doesn't keep up with inflation. And so if you're going out and buying a treasury bill today, in 9 months to a year, when you go to reinvest, you've got what's called reinvestment risk, and those rates probably won't be there, and they're going to be lower most likely. So just something to be aware of. I mean, while it's a nice thing to have, we still are believers that you still need bonds and stocks for the long run, because cash will not keep up with inflation.
What do you usually suggest in a client's portfolio as to what kind of reserve to have in their in their budget?
Yeah, Paul, you want to take that one?
Yeah, so typically we want to see 3 to 6 months worth of living expenses in cash at all times.
Okay.
Yeah.
So yeah, that's just if the roof leaks or whatever life throws at you, you have cash on hand to handle that sort of stuff.
And
Let's
for
go to the next slide.
And just real quick on that, a retiree, typically 6 to 12 months. It just depends on the
kind of income they have, Social Security,
Yeah.
pension plan, etc.
You got it. Yep.
I love this slide.
So the other thing is just beware of hot tips. There's always something that Wall Street's trying to push, some new investment fad, cryptocurrencies, AI today, artificial intelligence, whatever it is. We've seen it time and time again, going back to the 1600s with the Dutch tulip mania. Yes, tulips were being sold and were a bubble.
$250 a bulb.
Yeah. Trading with the South Sea Company, railways in the 1800s, the Roaring 20s, and leverage that was being used, and trading to the .com, to most recently FOMO, fear of missing out on some of these stocks that get in the media, in different social media channels, think GameStop and so on. And what happened last year is they all came crashing down. Markets were down, stock market was down anywhere from 16 to 20% globally last year. But some of these speculative stocks were down 50+%.
Do the industry promote speculative investing?
Oh, for sure. You look at how many investment mutual funds, exchange traded funds get launched each and every year. So, I mean, I can't even count on both my hands and my feet how many new products are launched around ESG investing, environmental social governance, around artificial intelligence. You name it. These products, they're in the news. Let's pump them up and let's sell them.
Yeah, I got the hottest new product.
Yeah. Social media has really changed the game, and unfortunately it's creating more bubbles, as we've seen 3 of them in the last 20 years.
Yeah, I think that's going to be more common, just because of this trading mentality that's taken place. And so I think it's a positive for long-term investors, those kind of buy and hold. I don't think that's a dead type of investing. So as more like the Warren Buffett, buy quality companies, hold them for the long run. You don't need to be trading each and every year and avoid these kind of hot tips that you hear from the neighbor. So
We
anyway.
didn't talk about this so much, but why is it important for a person to know what the turnover rate is when they buy a mutual fund?
Yeah, I mean, so turnover rate is how often are they turning over their portfolio, buying stocks and bonds or whatever they're investing in on an annual basis. And that's important because that generates, so say they hold Apple stock, they sell it and they had a big gain in it. That gets paid out as a capital gain that year in the mutual fund, and you pay taxes on that. And so it all comes back to, again, having a lower turnover, a more tax efficient vehicle, or putting certain investments in tax deferred accounts that are more tax sensitive.
Higher turnover equals more taxes equals less money in your pocket.
You got it.
Exactly.
Yep.
Are you guys going to talk about ETFs and index funds?
We didn't have a slide on it, but I can touch on it. Going back to that mutual fund slide, Paul, yeah, thank you. So it's the same thing. A mutual fund, ETF are very similar vehicles. They pool people's money together to make investments. The way they're created are a little different. I won't get into the technicals, but ETFs are more tax efficient vehicles. So
well, let's stick to index funds first. What is an index fund?
Yeah, so an index or a passive fund is just investing in whatever index it's trying to track. So
S&P 500 is an index.
Yep, S&P
Russell 500, the 2000 is an
yeah.
index. So there's
Yeah.
not a manager trying to pick stocks.
No, the manager is just trying to replicate that index. So you want an index, if you're buying in an index fund, you want an index that has low fees because they're always going to do a little worse than the index because of the fees coming from the account. And then someone who has what's called a tight tracking error, where they pretty much are trying to replicate it as close as possible. You don't want to buy an S&P 500 index fund and then get something different.
Okay.
So that's what passive is. Active manager is a manager who's actually trying to beat that index in any given year in a down market or a up market. So they're selecting stocks of that index that they think are going to do better.
So index funds are also used as benchmarks. What is it? Why is that important?
Yeah, because it's, I mean, really, if you pick a active fund or a passive fund and you're using it as a benchmark, you should really, I mean, it helps you measure how is that manager doing versus an index. If they can't be consistently over time beating that index, then just invest in the index.
Exactly. Now, what is an ETF? An exchange traded fund.
Yeah, so again, similar to a mutual fund, it pools people monies together. It's a little more tax efficient vehicle. So they're better to hold in taxable accounts because they don't typically produce capital gains like the mutual fund does. But they can be traded throughout the day. A mutual fund, you get what the end of day pricing is. So if the stock market was up 2% at 10 a.m. in the morning, you hit sell, and then the market ends up declining 4% and it ends up down 2% for the day, you get the end of day pricing. You get your sell positions down 2%. Whereas the exact opposite for the exchange traded fund happens. It was up 2%, you sold it at that minute and you get that price.
And it used to be that all ETFs were very low cost and very efficient. Today, that is not true. I think there are probably over 1,000 ETFs and being sold by brokerage firms. So be careful, and the underlying fees and expenses apply. You gotta know what the costs are.
Yeah, there's different types of ETFs, active ETFs. It's not all passive vehicles. Yes. Their ETFs can be more expensive than mutual funds. And often is the case where people think, oh, ETFs are lower cost vehicles. That is not always the case.
Yeah, let's go back to the other slide where we were.
Yep.
And
We'll wrap up here with the last couple things. So
well, most people think that when you invest in the market, that you know, people who invest in real estate, they can touch that property, they can visit the property, they see it go up, but they don't realize that you can also invest in real estate in the market. Why would somebody want to do that versus owning the real estate themselves?
yeah, I mean, one, it's hands off. You don't need to manage the property or hire a property manager. So it's could be lower cost. If we go back to those mutual funds or exchange traded funds buying in public markets, you get more diversification. So a public REIT, a real estate investment trust, you can go buy and you can have office properties, you can have industrial properties, storage units, apartments, so on. So you get more diversification, cheaper costs, and you don't have to have the headaches of managing a property. There are other private type vehicles, non-traded real estate investments, or private REITs, DSTs, Delaware Statutory Trusts, where you own various real estate. Again, it can be diversified. You actually own fractional interest in property. And so there are vehicles like that too. And it can increase your income potential and so on, and maybe help on some taxes, but the underlying fees are typically much higher. And then there's a lot of illiquidity. So like a non-traded or a DST, the typical time horizon or illiquidity is you can't take anything out for 5 to 7 years. When you invest, say, $10 for a net asset value, almost 1% of that is going to or 10, sorry, not 1%, 10% is going to the real estate company or the person who sold it. So you're only investing 9 out of that $10. So there's a lot of things to look out for, of lack of control, no refinancing, illiquidity, higher fees.
So be very aware of private partnerships.
You got it. Yeah.
Okay. And that could be in oil, they can be in gas, they can be in real estate. When I was with the Financial Planning Association, rabbits were the big thing. You know, everybody was going to make jackets out of rabbit fur. And because rabbit are prodigious in their reproduction, that everybody should make money. But private partnerships are loaded with fees, and you've got to understand them, and they're very illiquid. Yeah. And by the way, and as you get older, you need more liquidity for caregiving cost, for medical, for gifts to grandchildren, for travel, et cetera, et cetera.
Even, I mean, after your life, for an inheritance, you're sometimes there's certain clauses where you can get out with a death, but other times if they've like gated redemptions, you're stuck and you can't get out. So your heirs are stuck with the investment as well.
And they're just almost impossible to figure out as far as tax liabilities. Very complicated, and you're going to pay more to do your tax return when you have a partnership in your portfolio.
Yeah, they typically produce what's called a K1, and that K1, the accountant requires more fees to file that, and 2, that K1 typically doesn't come until after the tax filing deadline. So you have to file an extension as well.
Yeah, be sure to, again, if you're going to make an investment, ask how you get out of it before you make that investment. And that's the same with a financial advisor. And please see more than one individual. It's a marriage, and it's a great way to educate you on the portfolio, because when you're looking at a new potential client, you're looking at their portfolio and you're giving the client feedback, correct, as to what they own.
Yep.
Yeah. So, it's, and a lot of times it's relearning that, the language, because the financial world has its own language as you have heard today. So let's go to the next slide. I believe this is,
Last one.
yeah.
All right, reverse mortgages. So a reverse mortgage can be attractive for the right individual in the wrong situation. And I say the wrong situation because this is typically something you back into when there's no other assets left. What the reverse mortgage allows you to do is tap into the equity in your home and live off of that equity so you don't have to move. So a reverse mortgage is a very complex product, and it's a very expensive product. Not something that we lead with, but something that can be right for the right person. And like I said, in the wrong situation, who doesn't have any other assets, doesn't want to move and sell their home either. This can be a viable solution for someone in that sort of situation.
And they
Last resort.
Yeah, they have gotten a little better just because the way they were being sold, the industry cracked down on them.
Yeah.
So you have to go, I mean, just to get one, you have to set up an appointment with a third party, not the person selling you it, a third party to make sure this is what you need.
I recommend highly you see a CPA or a fee-only advisor and have them and discuss it with them before you do a reverse mortgage. And this is, again, it's being sold on TV and usually on the news because it appeals to older individuals. Should somebody, if they want to stay on top of the financial worlds, could watch CNBC?
Not unless you want to lose your hair.
I've already lost my hair, so
Yeah, no, I
That's
mean,
what Paul and I did as well, too early in our career.
yeah, no, I mean, the reality is the markets are a living, breathing entity. They're going to do their thing each day. Historically, we know that the markets are going to go up more often than they're going to go down. So over a 5-year cycle, historically, the markets go up 4 years and it goes down 1 year.
okay.
And so, yeah.
Let's put us on the screen, Don, and yeah, there's a number. If you'd like to contact them, please do. They'll be happy to answer any questions. No high pressure. There's no obligation and there's no cost. And I really appreciate you guys coming on, volunteering your time and presenting this, because you guys are the opposite of the real investment world. There is a question out there, and it states, in the industry often equates price and fee as cost. However, they're not the same. If there's a proven net value, people are willing to pay for a high price. And what I get out of this is that it's a marketing strategy. People think that if it's a higher price, then they're getting a better product. Is that true in the financial service industry?
Paul, why don't you stop sharing your screen?
Oh, yeah, sorry.
Thank you.
Here's what I would say. Cost is not the only factor that you look at when making an investment decision. There's many factors that you need to look at. You know, there are, for example, active mutual funds that are more expensive, but they have higher returns and they've had higher returns over time. So it's okay to buy a more expensive product if it's going to produce higher returns, or historically it's produced higher returns. Hopefully you're getting what you pay for in that situation. The challenge is too many times you're not getting what you pay for in those scenarios.
Yeah, that's it. And that's where the terminal comes in, the 7 people who are searching the 25,000 different mutual funds. It's trying to find that fund manager that is doing well consistently. So, and there's a lot of people who believe that there isn't a manager out there that beats the market consistently. So, and we're going to talk more about passive and active investing in a future session. So, but let's, Don, you want to open it up for Q&A?
So what we're going to do before we do that, however, is my name's Don Vivrette. This has been Financial Estate Literacy. It's Your Money, the investment world. We've been talking today. I thank very much for Michael and Paul in terms of what all they've gone through. And what I'm going to do at this point is I'm going to turn off the video, the recording.